welcome to this deep dive, especially for you, the learner. We're getting into financial reporting today.
That's right. We've got materials on the balance sheet, income statement, comprehensive income, EPS.
Right, and public company reporting, stockholders' equity. Quite a bit.
Yeah, and the mission really is to see how these core ideas link up.
To make the financial statements tell a clearer story, right?
Yeah.
Not just numbers.
Exactly. A story about the company's, well, it's financial health.
So let's start with the big ones. Balance sheet, income statement, and maybe that comprehensive income piece.
Sounds good. Then we can touch on how public companies share this stuff and dig into equity.
Okay, let's jump in. The balance sheet.
Yeah, what's really key here is how these statements, they interlock. The balance sheet is like, well, think of it as a financial photo, a snapshot.
A snapshot. So just one specific moment in time.
Precisely. It lists assets, so that's what the company owns.
Okay.
Liabilities, what it owes to others.
Right.
And stockholders' equity, that's the owner's stake.
And seeing current assets versus current liabilities, that tells you something quick.
Oh, definitely. It gives you a sense of their short-term flexibility, liquidity.
Got it. So snapshot is the balance sheet, then the income statement.
Mm-hmm.
That's different.
Totally different. That shows performance, but over a period of time.
Like a movie, not a photo.
Kind of, yeah. Shows revenues coming in, expenses going out.
And the bottom line, profit or loss.
Right. And you might see it in a couple of ways. Multi-step, which separates out operating stuff.
Or the simpler single-step version.
Exactly.
Yeah.
And interestingly, if something unusual happens, like a big one-off gain or loss, that gets reported separately. So you can still see the ongoing business performance more clearly.
Okay, that makes sense. What about selling off part of the business?
Yeah. Discontinued operations. If it's a significant chunk they're selling or planning to sell, its results get pulled out and reported separately at tax.
So it doesn't distort the picture of the continuing business.
Right. And once they decide to sell, things like depreciation and amortization, they just stop for those specific assets.
Interesting detail.
Right.
Okay, now, lots of companies work globally. Currencies change.
Big topic. Foreign currency transactions. If the exchange rate moves between when you agree a price and when you actually pay.
Or get paid.
Right. That creates a gain or a loss. And that hits net income.
And you have to track of that.
You do. Especially for amounts still outstanding at the balance sheet date, you need to recalculate.
Okay. So net income captures a lot, but you mentioned something broader.
Yeah, comprehensive income. Net income is like the main engine, but it's not the whole story of equity changes.
How so?
Comprehensive income includes net income, sure, but also other changes in equity that bypass the income statement, at least initially.
Like what, for example?
Things like unrealized gains or losses on certain types of investments or foreign currency adjustments related to overseas subsidiaries.
So it gives a more holistic view of value changes.
Exactly. A fuller picture.
Okay. And public companies, they have to share all this, right? SEC filings?
Absolutely. Transparency is key. Registered U.S. companies file the big annual report, the 10K.
That's the one with audited financials and management's discussion.
Yeah. Then quarterly updates. The 10Q is usually unaudited, more condensed.
And if something big happens suddenly?
That triggers an 8K filing. Pretty quick turnaround, too, within 4 business days usually for material events.
Wow. Okay. So lots of reporting. Yeah. And a number investors always look at is EPS, earnings per share.
Crucial metric, especially for public companies. They have to report it. If it's just common stock, simple structure, they report basic EPS.
Basic, okay, but sometimes it's more complex.
Right. If there are things like convertible bonds or stock options, things that could become common stock.
Potential new shares.
Yeah, potential dilution. Then they have to report both basic EPS and diluted EPS.
And diluted EPS shows the impact if all those potential shares, actually converted.
That's the idea. It's a more conservative kind of worst-case scenario number.
Gives investors a heads up. Okay, let's zoom in on stockholders' equity itself. What exactly is in there?
So fundamentally, it's the owner's residual claim. What's left of the assets after you pay off all the liabilities?
The owner's piece of the pie.
Pretty much. It includes the capital stock common, preferred usually at a par or stated value. Then additional paid-in capital, or APIC. That's the money investors paid above that par value.
Okay, the excess.
Right. Then retained earnings, all the profits the company has kept over time, not paid out as dividends.
Accumulated profits.
Yep. And also that accumulated other comprehensive income, or AOCI we talked about earlier, those unrealized items sit there in equity.
Ah, okay. So it connects. What about treasury stock? I see that sometimes.
Good point. That's when a company buys back its own shares from the market.
Why would they do that?
Various reasons, maybe they think the stock's undervalued or they need shares for employee stock plans.
How's it accounted for?
Two main ways. The cost method is common, just record the shares at whatever price they paid to buy them back. Or the legal or par value method, which is a bit more complex, adjusts the original capital accounts.
And if they sell those shares again later, does that make a profit or loss on the income statement?
No, that's key. Gains or losses on reissuing treasury stock go to paid-in capital, part of equity, not net income.
Right. Transactions in your own stock don't create operating profit.
Exactly.
And finally, companies giving value back. Dividends, stock splits.
Yeah, ways to return value or adjust the stock structure. Dividends can be cash, obviously, but also property or even more stock.
Stock dividends. Different from stock splits.
A bit, yeah. Small stock dividends are recorded based on the stock's market value. Large ones, closer to a split, often use the par value.
And a stock split, like a 2-for-1.
Right. That just increases the number of shares everyone holds and cuts the par value per share proportionally. Total equity doesn't change, just more cheaper shares.
Okay. Wow, that's a lot of interconnected pieces.
It really is. But you see how they fit. Balance sheet snapshot, income statement performance over time, comprehensive income, the broader value changes.
And equity details the ownership structure and accumulated value.
Right. And public reporting wraps it all up for investors. It paints a detailed financial story when you look at it all together.
So, the learner, we've really journeyed through the core of financial reporting, from that balance sheet snapshot, the income statement story, that wider view with comprehensive income.
We saw how public companies report, how EPS works, and what makes up stockholders' equity, including things like treasury stock and dividends.
Yeah. We hope this deep dive brought some clarity, maybe some aha moments. As you think about this, consider how these statements really talk to each other. They aren't isolated.
How does understanding the balance sheet help you interpret the income statement, or vice versa?
What connections really stand out to you now, thinking about how they paint that complete picture of a company? Something to mull over.